This video will help you understand how to navigate through the IRS's pro-rata aggregation rules if you have an IRA already on your balance sheet and you want to do Back Door Roth IRAs. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. So it's not uncommon that folks will come into my office and be a perfect candidate for doing a Back Door Roth IRA. However, they'll already have an existing pre-tax IRA on the balance sheet. If you aren't aware of how that's a problem, or you have no idea what a Back Door Roth IRA even is, that's okay, because in today's video, we'll bring you up to speed on how this strategy works, and we'll share with you how to play within the joints of the IRS's rules and regulations as it pertains to funding IRAs, converting them, and trying to minimize taxes the whole time. So let's jump in. So we might end up getting a bit nuanced in today's video, but I'll do my best to timestamp below particular segments of this video so that you can jump ahead if your financial acumen is sophisticated enough to skip certain parts. That being said, the concept of doing a Back Door Roth IRA is kind of financial planning 301, and I would say you don't even need to worry about this strategy if, number one, you have room to grow before you've maxed out your own Roth 401k, or you have room to grow in your spouse's Roth 401k before you've maxed that out, or perhaps even if you have access to an after-tax 401k, and this is particular for larger companies like tech companies in Seattle and things like that. This is a third bucket you could contribute to as part of your 401k plan. And if you haven't maxed that out either, I really wouldn't worry about the concept of doing a Back Door Roth IRA. But let's say you've maxed out your Roth 401k, your spouse's Roth 401k, and your after-tax 401k, and you still want another place to fund Roth money into, then I'd definitely look at doing a Back Door Roth IRA. That being said, before we get into the specifics on how a Back Door Roth IRA even works, let's talk about how you can go about even funding an IRA. And later we'll touch on why having a pre-tax IRA on the balance sheet is a problem if you want to do this strategy. So starting from the basics, you have three ways of funding an IRA. You can either fund a traditional IRA in a pre-tax fashion and take a tax deduction. You could fund a Roth IRA, take no tax deduction but have that money grow and compound tax-free. And thirdly, you could fund a traditional IRA again, but do it in a non-deductible fashion, meaning you don't take any cool tax deduction, you've contributed this much, and then as the money grows and compounds in that account, a portion of your withdrawal when you're in retirement will be considered tax-free, and a portion will be considered taxable income, and that'd be the gain portion. Based on your modified adjusted gross income, which is basically your adjusted gross income, that will dictate which strategies you can or cannot employ. In addition, if you have access to a 401k plan type through work, this would be considered you being an active participant. That will also affect which strategies you can access. However, regardless of how much money you make, even if you make $1 million a year, you can still fund a traditional IRA in a non-deductible fashion. That means even Jeff Bezos and Elon Musk can fund a traditional IRA in a non-deductible fashion at $7,000 a year. Well, actually $8,000 because they're both over 50. And there's a catch-up contribution of $1,000 when you're over 50. One question I get a lot on funding an IRA is it doesn't matter how much you're putting into your 401k, that doesn't decrease how much you can put into your IRA. So that $7,000 or $8,000 limit is not affected whether you put in 10 grand, 20 grand, whatever, into your 401k. That means theoretically, like I mentioned before, you could max out your 401k at 23 grand or 30,500 if you're over 50, and still then go and max out an IRA. But as I mentioned before, how much your income is will dictate how much of that IRA contribution can be pre-tax IRA, Roth IRA, or at a bare minimum, non-deductible traditional IRA. If you're curious what your modified adjusted gross income is, it's actually not shown on your tax return, but your adjusted gross income is on line 11 of your Form 1040, and that's a pretty easy approximation for your modified adjusted gross income. For 2024, if your family makes over 240 grand, or as a single person, you make over 161,000 in modified adjusted gross income, then you can't fund a Roth IRA, and your only option in funding an IRA would be to fund a traditional IRA in a non-deductible fashion. But if your family makes above those limits and you still want to get money into a Roth IRA, but you can't directly make that contribution, that's where the concept of doing a Back Door Roth IRA comes in. So let's talk about how that works. Now, in the normal sense of things, you are SOL as it pertains to directly funding a Roth IRA. But by employing a Back Door Roth IRA strategy, you can somewhat circumvent, but totally legally, the Roth IRA contribution limits by doing two steps instead of one. And those two steps are, number one, funding that non-deductible traditional IRA like we just talked about, you're not taking a tax deduction. So now when you go and do a Roth conversion, which is part 2 of the strategy, when you Roth convert the $7,000 non-deductible traditional IRA contribution you made, when you Roth convert that, there will not be any sort of taxes because you never took a tax deduction in the first place when you funded that IRA. Now, just to quickly clarify, if there's any gain inside the IRA from when you put in the $7,000 to when you converted, and let's say you ended up converting $8,000 because the IRA grew by $1,000, that $1,000 will be income taxable. However, as opposed to a normal Roth conversion where normally you're converting all pre-tax money, such as if you did a $100,000 Roth conversion, generally for most people, that $100,000 will have been from all pre-tax money. That means in the current tax year, you'll pay income taxes on the total amount you converted. So if you converted $100,000 and your marginal rate is 24%, you'll pay $24,000 in taxes. Now you still convert the full $100,000, which means you need to reach into your pocket and pay the IRS $24,000 from somewhere else. You generally don't want to pay the IRS from your retirement account because that involves taking a distribution, which is income taxable, and if you're under 59.5, would be considered an early distribution, which would cost you another 10% in taxes and is generally not a good idea. When you fund that IRA, you'll generate a Form 5498. When you do the Roth conversion, you'll generate a 1099-R from the investment custodian. You don't need the 5498 for your tax return. You do need the 1099-R for your tax return. So just keep in mind if you're going to do these strategies, there's a couple of tax documents you're going to want to be aware of. In addition, when you fund the IRA in a non-deductible fashion, that should populate a Form 8606 on your tax return. That's what you use to track any non-deductible IRA contributions you made during a particular calendar year. Now, it's actually not necessary to track your non-deductible IRA money every single year via Form 8606. For example, let's say 10 years ago, you funded your IRA in a non-deductible fashion and you generated a Form 8606. Technically, you don't need a Form 8606 every single year to track that, but generally it's a best practice to file a Form 8606 just to make sure all your records are kept up. In addition, if you switch like CPAs, it oftentimes can be helpful to maintain that continuity if they don't have to go back in time 10 years ago to see you had a Form 8606 then. Because if you don't track your basis, when you go into a Roth conversion, the IRS has no reason but not to fully tax you on the Roth conversion. So now, why does having an IRA already on the balance sheet become a problem when you want to do this strategy? Well, simply put, if you have any pre-tax money in the balance sheet, when you do your non-deductible IRA contribution, the IRS will look at your pre-tax IRA and your non-deductible IRA contributions and pool it all together into one big pot of, let's say, 90% pre-tax and 10% after tax. Now, that's not necessarily a problem, but when you go and do a Roth conversion, now the IRS will look at that balance as one big mixed up pot of IRA money. And so when you go to do the conversion, depending on those percentages of pre-tax and non-deductible money, that percentage that you convert will be income taxable in that respect. So for example, let's say I had a $93,000 pre-tax IRA from an old 401k I rolled over years ago, and then I go and do a $7,000 non-deductible IRA contribution. When I go and do the second half of the Back Door Roth IRA, which is the conversion portion, and let's say all I wanted to do was convert the $7,000 in non-deductible IRA money, I can't actually parse out what part of my IRA total pooled balance I want to convert. The IRS, like I said, mixes it all together. So if I have a $93,000 pre-tax IRA and $7,000 are added to it in non-deductible fashion, that means of my total Roth conversion I do of $7,000, 7% of that $7,000 will be considered a tax-free Roth conversion, and 93% of that conversion will be considered income taxable to me. Now, it's 93% of like 7,000, so it's not that big of a deal. But at the bottom line is, I wanted to do this strategy and not pay taxes, and this is preventing me from doing that. And I know what you might be thinking, why not just have a pre-tax IRA and then open up another IRA and do your non-deductible contribution over there? It doesn't matter. The IRS pools everything together, and that's considered the pro-rata aggregation rules. So what's a particular way around this? Well, I'll link above to my previous video on how to do this, but the easiest solution is to move all your pre-tax IRA money into your current company or old company's 401k plan if the 401k plan permits incoming rollovers. For a breakdown on how to do that logistically, I'd recommend watching my previous video. But to keep it simple, if you don't have any pre-tax money on the balance sheet anymore, because you did an IRA to 401k rollover, then when you go into a Back Door Roth IRA, there should be no aggregation rule to be had because there's nothing to aggregate your non-deductible IRA contributions into. There's no more pre-tax IRA money on your balance sheet because the IRS pulls together IRAs, but they don't pull together all pre-tax money, which means even if you had a $3 billion pre-tax 401k, you could still do a Back Door Roth IRA as long as you don't have any pre-tax IRA money on the balance sheet. Now, from a timing standpoint, ideally you would move all of your pre-tax IRA into your 401k completely and then do your non-deductible IRA contributions and the subsequent conversion. But even if you fund your IRA and you realize quickly, oh crap, if I do this conversion, I'm going to end up paying some income taxes, you can actually then still parse out pre-tax IRA money from non-deductible IRA money because your 401k plan can only accept pre-tax IRA money. That means, going back to that $93,000 IRA example, if I've got 93 grand in a pre-tax IRA and I put 7 grand into it, now I have $100,000 in total IRA money. If I stroke a check to my 401k plan for 93 grand, I can theoretically remove all of the pre-tax IRA money off my balance sheet, even though my IRA is actually worth 100 grand, thus leaving only the after-tax portion of my IRA, which in this case is $7,000. Then when I go and do the Roth conversion, I'm only Roth converting non-deductible IRA money, because again, there's no pre-tax IRA money on my balance sheet to pro-rata aggregate for the purposes of that conversion. Therefore, the $7,000 conversion would be theoretically tax-free. And for a reference on that Internal Revenue Code section, I'm going to read it off because I don't have it memorized. 408D3A2. And that basically outlines that 401k plans can only accept pre-tax IRA money. They cannot accept after-tax IRA money. Now, there is some disagreement in the tax space as to the perfect funding of when you can move your IRA to your 401k, when you can fund your IRA, and then when you can do a subsequent Roth conversion. There is no disagreement, however, as to whether or not you need to wait for all your pre-tax money to get off the balance sheet before you do said Roth conversion. And that's because if we do the conversion when we still have pre-tax money on the balance sheet, then that Roth conversion will be pro-rata aggregated together, and you'll end up paying a few bucks in income taxes on the Roth conversion, which is what we're trying to avoid. Without getting into the specifics, essentially there's just no crystal clear guidance from the IRS on exactly how they want you to time everything. For example, let's say it's March 2025 and I'm doing my 2024 $7,000 non-deductible IRA contribution. And then in March, right after I make that contribution, I then move my IRA to my 401k, and then the next day I do an IRA to Roth conversion. Philosophically, I did everything in sequential order, meaning I had all the pre-tax money off the balance sheet just fine, and then I did the Roth conversion, no harm, no foul. Again, philosophically, that makes sense. However, from a tax perspective, a lot of times the IRS will look at things on a calendar year basis, kind of myopically. And so if the IRS does that, then some tax professionals will err on the side of caution and say, hey, if you're going to fund an IRA and then move pre-tax IRA to 401k, let December 31st eclipse before you do any sort of Roth conversion. That way, if the IRS sees a statement of December 31st's IRA for you, they only see that $7,000 non-deductible IRA contribution because earlier in the year you moved your IRA to your 401k. Then come January 1, if you were to do a Roth conversion, 7 grand IRA to 7 grand Roth IRA, which again would not be taxable because you moved all the pre-tax money off the balance sheet, then the IRS would have no problem with that. Other tax professionals would say, hey, as long as you can show the intra-month statements that, hey, we had 100 grand in IRA money, we moved 93 grand of pre-tax to the 401k, and then we've got a statement showing only 7 grand left in that IRA, and then you do the Roth conversion the next day. As long as you have statements that show sequentially what happened, then you should have no problem. Now, personally, I like the tax professionals that agree to, as long as you can generate the statement and back it up, you're good to go. However, I would recommend doing whatever your tax professional recommends, because they're the ones that are gonna go to bat for you if the IRS ever comes knocking. And knocking by way of saying, hey, that $7,000 conversion you did, even though you moved the IRA to 401k earlier, is actually 90% income taxable. We'd like some more revenue, please. In addition, while yes, you have until April 15th of the next calendar year to fund the previous tax year's IRA, personally, I like to keep it very clean from a tax reporting perspective and say, hey, anything we want to have occurred in 2024 needs to occur before December 31st. And while yes, there are some times in which we might need to wait until January, February, or March of the next calendar year to fund a previous year's IRA, usually by running some tax estimates in the spring, we'll know with reasonable certainty whether or not by the end of the year, a particular client will be over an income threshold for funding a Roth IRA and should just do a backdoor Roth IRA to keep it simple. And again, the goal would be to get everything knocked out before December 31st in that calendar year. That way there's just not a whole lot of tax reporting issues we run into when filing tax forms for a previous calendar year. But sometimes we gotta make exceptions, and for those exceptions, you just wanna make sure your tax professional understands what's happening sequentially. Okay, so from a calls to action standpoint, I definitely look at your situation and see if you would benefit from doing a backdoor Roth IRA. And you'd benefit if essentially you wanna put more into a Roth IRA, your income prevents you from doing that, and you've maxed out your other ancillary Roth options, such as Roth 401k contributions or after-tax 401k contributions. If you have a pre-tax IRA in the balance sheet and that would disturb you doing a tax-free IRA fund and Roth conversion, then I'd look into some strategies to move the IRA off the balance sheet, ideally to your 401k or retirement plan. That's probably the easiest solution to free that money up. And then you could look into doing backdoor Roth IRAs. However, I'd always recommend you speak with your tax professional on what might be in your best interest here, and potentially there's some nuance to be aware of that they would know in your situation. If you have further questions, drop them in the comments below or get in touch with the website. We'll help you get squared away. Have an awesome rest of your week. We'll talk to you later. Bye.